Good morning to Sejasman Tuyon, and today we will be presenting a firm capital structure in theory and practical perspective. My name is Vikshal Gipin and I will be presenting the introduction part. So for the first part is, what is the definition of a firm capital structure? The term structure gives the meaning of arrangement of a large network. So the words capital structure means the arrangement of capital that comes from different sources to fund a firm or a company. Capital structure is the combination of debt and equity used by the company to finance its operation and for their business growth. There are two types of capital structure. The first one was known as the debt capital, where the debt ratio is higher than the equity ratio. When a company using a debt capital for the sources of fund, they will be taking loans, whether it is a long-term or a short-term loans. For the second type of capital structure, it was known as equity capital, where the equity ratio is higher than the debt ratio. Equity capital is where the money that being put up by the shareholders that become the sources of fund for the company. So for the second part is why a firm capital structure decision is very important. Firm capital structure is the structure that shows how a company utilizes the sources of fund in maximum and safest ways that can support the company in the operation and growth. It is up to the company on how they want to shape the capital structure, whether more on debt or more on equity. If the company using an unsuitable capital structure for the company, they might run into a problem in the future in order to maintain their inflow and outflow of money. A proper capital structure will help the company to fully utilize their fund sources correctly and run their business smoothly without any problems such as loan payment or dividend payment. Next is a sample of firm capital structure, where we choose 7-Eleven Incorporation as our sample for analyzing capital structure. Based on the balance sheet of 7-Eleven that we take from their annual report for 2020, we found that this firm is 56% on liabilities and 44% on equity. Since we know that a company will have a higher risk for investor when a firm are more on debt capital, we can conclude that 7-Eleven has higher risk for investors. However, we know that this firm is not a new company, which means they can handle their debt payments with their inflow of money. And moreover, when a company using debt capital as their sources of fund, this will help them in terms of operation and growth.
Assalamualaikum and hi, my name is Muhammad Safwan bin Asta. Today I would like to talk about the review on the capital structure theory. First of all, there are 4 theories that are involved in this capital structure, which is Modigliani-Miller theory, agency cost theory, pecking order theory, and the last one is signaling theory. For the Modigliani-Miller theory 1958 consists of true proposition and have a different approach in the propositions. This means the first propositions include proposition 1 and proposition 2 with text and without text for both. We can see the differences of this proposition based on their own assumptions. For the second theory is the agency cost theory on this capital structure. According to the Jensen and Meckling 1976, presented that this theory refers to the costs that have occurred between the shareholders and the debt holders or creditors of the firm, which is being called as the cost of disagreements. Besides, for the third theory is pecking order theory. This theory is known as the pecking order model that have been made popular by Stuart Myers and Nicholas Majdouh in 1984. Arises from the concept of asymmetric informations. As we can see, asymmetric information is way being called as the information failure in the system because of the imbalanced transaction power that have arises. The last capital structure theory that will be presented today is the signaling theory. Signaling theory refers to the act of using insiders' information, which is non-public fact, that gives traders an advantage when trading in company stock. In other words, if the company feels that their firms are cheap, they have to use their debt first and keep the stock as their last option. Okay, now let us move on to the briefly explanation on the Modigliani-Miller theory. The irrelevance of these capital structure theories is advanced by the Modigliani-Miller, which have been developed in 1958. As I have told before, there are two propositions in the Modigliani-Miller theory, which is Proposition 1 and Proposition 2, both with text and without text. Here I will clearly explain about the Proposition 1 and Proposition 2 with texts. For the Proposition 1 with text claim that tax shield resulting from tax interest payments raise the value of a leveraged company. This means the debt in the firm is valuable because it has the ability to shield the firm from the tax. With a higher debt, the firm have to pay a higher interest, which will encourage the firms to cut off their tax slower than before. For the Proposition 2 with tax tells that the cost of equity is lower than the situation when without tax. This means the cost of equity increases as the debt increases but cannot more higher than the situation Proposition 2 without taxes because it cannot increase significantly.
Good morning, sir. My name is Audrey Alfred and I will be presenting about agency cost of equity theory, pecking order theory, and signaling hypothesis theory. Basically, agency cost is the type of expenses that incurred because of a conflict between a company shareholders and its manager. The relationship between the shareholders and the manager is called as agency relationship, whereby the shareholders will be the principal and the manager will be the agent who is going to work on behalf of the principal to do a decision making. If both parties in the relationship are utility maximizer, there's a reason to believe that the agent will not always behave on behalf of the principal best interest. This is because shareholders expect managers to make decisions that will maximize their profit. On the other hand, managers only want to make decisions that will profit the company or grow the company. Thus, shareholder will incur costs, which is agency cost of equity, to control the management decision making. Next, pecking order theory is about how a company's manager finance their project either through internal financing or external financing. Pecking order theory exists because of the asymmetry of information. It is when one party possesses more information than the others. For example, an investor makes a better estimation about the company more than the manager itself, causing the managers to have the difficulties in issuing equity, for example. This is because the investor would assume that the stock is overvalued. Thus, no one will buy the stock. Therefore, Meyer states that retained earnings are preferable to debt, whereas debt is preferable to equity. Reason for this is that internal financing is much cheaper than external financing. Investor skepticism can be avoided as well. Apart from that, signaling theory also exists because of the asymmetry of information between the company and the shareholder. Signaling is about sending and receiving information. The use of insider information to begin a trading position is the type of activity that refers to signaling. This happens when an insider discloses critical information about a firm, causing people who do not normally have insider information to purchase or sell the company's stocks. Outsiders will regard the insider's activities to be a market signal. For example, if the company announced that they will incur debt in which indicates the company is creditworthy and seeking fund for expansion, it will attract the investors as they believe that it is a good stock to buy.
Assalamualaikum, hello, my name is Muhammad Tuas Alkorni bin Abdul Halim. Today, I will be talking about practical aspects of firm capital structure. First of all, I'm going to go through how we determine optimal capital structure. So the best way to find an optimal capital structure is through WACC. It is a good measurement for both the company and the investors. For the company we've chosen, 7-Eleven, we can gather the financial statement from 2019 and 2020's annual report as that WACC for 2019 is 6.5% and the WACC for 2020 is 2.69%. So from 6.5 to 2.6. So there is a decrease from 2019 to 2020. What happened? This happens because there is an increase in debt, but at the same time, stockholders will receive more return. How it works is that we can see that there were the common stock. Even though the debt increased, the common stock also increased from 56,000 in 2019 to 123,000 in 2020. Next, capital structure decisions. How were they made? Well, capital structure decisions were made in stone according to the situation they're in. It is according to the assets and liabilities of the company. Those are the capital structures. In 2020, there was a huge distraught, of course, the pandemic. So because of this, 7-Eleven took action. As we can see from the difference of WACC, they had a loss in revenue due to, of course, the pandemic. And because of the government's recovery, there is a good way for the 7-Eleven to increase and adapt and evolve to make sure they will strive in the industry. Next, financial distress. What is financial distress and how does it affect capital structure? Well, financial distress is an outcome from a manager's decision and choices. It doesn't correlate to the capital structure of the company, but the choices they made or the strategy they have started. Capital structure is a debt and equity. It doesn't matter. Financial distress is only an outcome. What financial distress is, in another word, is bankruptcy. Whatever choices and decisions the managers make towards the company, it may lead to financial distress, bankruptcy. Of course, if you go aggressive on your company policy, you're bound to be faced with insolvency. Next, tax and financial distress costs. What are tax shields and how does it offset by financial distress? Tax shields are beneficial to companies because it covers most of the tax. How do we get tax shield to begin with? Is to have more debt. But with more debt, we will face a lot more financial distress. With more debt, there is going to be a higher percentage of you going bankruptcy. So there is going to be an equilibrium of tax shield and financial distress, whereas if you imagine there's this much tax shield and then there's this much financial distress, so there is a little gap between the bottom tax shield and the bottom of financial distress. That is where it is beneficial to the company, and it is called optimal capital structure. Thank you very much. That's all from me.
To sum up, a corporate finance decision for a firm capital structure in the real world is not an easy task and not a one-day process. They need to take it seriously since it will determine how they can utilize and maximize the sources of funds in the long run for their own benefits. Besides, if they take a wrong step, it has the possibility that this company might face bankruptcy or total loss. A firm needs to concern about the factors affecting the debt and the equity ratio, which is the taxes, types of assets they invested in, and the uncertainty of operating income. Besides that, they need to concern about their financial flexibility. They need to know that even during the downturn, they were able to handle the debt or paying dividend to their shareholders.